for the invitation. And I will try to talk about this topic in a way that addresses the social or a social policy angle to address more. There are several. I would need more time, but I will try to give you a brief overview of the work that I have already done on this, and then some thoughts on how asset manager capitalism relates to social policy in general and pension policy in particular. So what is asset manager capitalism as I understand it? At the very macro level, or at the level of the evolution of the financial system, there has been a relative decline of the banking sector relative to the rise of what I would call institutional capital pools. So financial institutions that are not banks, so-called non-bank financial institutions. And the largest of those include asset owners, meaning pension funds, and also insurers. They would also fall under asset owners, and asset managers. So the firms that manage assets on behalf of others for a fee, but are not themselves the beneficial owners of those assets. The other macro dimension that I would like to highlight is that I see a shift in the function of the financial sector in the economy from financing economic activity and especially corporate investment towards, well, asset management. Another word for this would be wealth preservation. The two functions always go together. The financial sector always does both. Today in the class that I'm teaching here this semester, we talked about balance sheets. And well, from the perspective of financial institution, there's always the function of investment on the asset side of the balance sheet, and the function of, well, wealth preservation for their customers on the liability side. So your bank deposit is, of course, your wealth, and that is on the liability side and the same is true for fund shares, for example. So a shift from financing to asset management. The driving force for financial intermediation is, to a much larger extent than in the past, not the corporation coming to a bank saying, I would like to get financing for this very large investment project here that costs $100 million. And it is increasingly the pension fund that comes to the asset manager and says, I would like you to manage these $100 million for me, and I don't care how you invest them. Which is a very different dynamic. Of course, they care, but the actual real economy investment project is not the driving force of this. Now, we can look at the impact on the non-financial economy of the rise of asset manager capitalism. And there we can distinguish three spheres. One is realm of the public corporation, meaning the stock market listed corporation. And there I have done quite a bit of work on asset manager capitalism as a corporate governance regime, and I'll briefly talk about that. But then there is also the rest of the economy, which comprises private companies. I should call them companies here, not corporations. And there one can observe a financialization of the ownership model for private companies. So that's about private equity buying companies, private equity asset managers buying companies. And also, well, there is also the non-corporate economy, or what one could, in very generic terms, describe as the social infrastructure, which includes health and care facilities, schools, universities, and housing, of course. And this non-corporate part of the economy is also increasingly, let's say, a target for investment by institutional investors and their asset managers. So we will talk about the second part in the second part of the talk, when we talk, and throughout there is a certain focus on what drives the growth of asset manager capitalism, and that is where I really see the most important, a very important link to social policy, because it's really two things. Simply put, one is wealth inequality. The more wealth inequality there is, the more wealth is with households or individuals, very wealthy ones, that invest in financial assets. Whereas for most of the middle class, if they have a major asset, it's usually their portfolio is dominated by their home, the house they live in, which doesn't require much financial intermediation once you've paid off your mortgage. Whereas millionaires and billionaires, of course, invest much more in financial assets. That requires asset management. And the second driving force is social policy in general, but pension policy in particular. A pay-as-you-go pension system requires no financial intermediation, whereas a fully funded pension system requires very large amounts of financial intermediation. So pay-as-you-go, we'll talk about this in a minute. All right. So what about asset manager capitalism as a corporate governance regime? I would have been more fluent probably had I had my presenter's view here, but due to Zoom issues, I don't, but I still can explain this investment chain to you. So this is what I would call the equity investment chain. You have the issuers of corporate stocks on the right-hand side, corporations, and you have the beneficial owners that are at the end of the investment chain, that the shareholders or the beneficial owners who are the ultimate recipients of share price gains and dividends. But in between, today, there are two other groups of institutional capital pools. One are the institutional investors, which includes pension funds, university endowments, sovereign wealth funds, and one could also add insurers here, that pool capital from many households to invest them in financial assets. Over the last 30, 40 years, a second layer institutional layer has been added to this investment chain. And these are our asset managers, which includes plain vanilla mutual funds. So just funds that invest in bonds and equities, but also so-called alternative asset managers, such as hedge funds and private equity funds. And we'll talk about those later. For the corporate governance story that we're talking about in the next 5 minutes, what we're talking about is really the providers of mutual funds and of exchange-traded funds, or ETFs. So BlackRock is the largest of these companies, and most of you will have probably heard of it. And then there are many others. Vanguard, State Street are the next two biggest ones. And as you can see, these firms manage capital for these upstream asset owners by investing them here in the assets emitted by the corporate sector. The returns flow back in this direction, and then these intermediaries are paid fees, either by those institutional investors, or you can also, of course, directly as an individual purchase shares in a mutual fund or in an ETF, and then you would pay the fees directly to those asset managers. There are a variety of other intermediaries and consultants in this universe, but they don't need to concern us here. Now, both when we talk about these plain vanilla mutual funds and ETF providers, and when we talk about hedge funds and private equity later, it is very interesting to look at the importance of pension capital for the growth of this asset management sector. And I've done quite a bit of digging to be able to show you this. So here we have on the left-hand side, the rise of retirement assets in the United States. The biggest pot of pension assets, of course, is in the US, of like 35 trillion US dollars, which come from various types of retirement schemes and plans. The details, we don't need to look at the details now. Then here we have total mutual fund assets, which are lower than total retirement assets, but also very high, above $25 trillion. And then here we can see the share of mutual fund assets that are retirement assets. So of those $25 trillion invested via mutual funds, actually, more than 45% are retirement assets. So almost 50% of the business of these asset managers is accounted for by retirement assets. Remember that 50% number. Now, why does all this matter from a corporate governance perspective? Here you can see the ownership structure of US corporate equity since 1945. You see the US corporate equity ownership structure since 1945 in the United States. And what you can see, basically in mid-century, all corporate equity was held, pretty much all of it was held by households. There was very little intermediation. The investment chain was short. There was almost nothing in the middle. Then, starting in the 1960s, 70s, and 80s, you had a steady accelerating growth of especially public and private pension funds. That's this category here, and then the green one here, and also, of course, other intermediaries, mutual funds, and insurers. In 1985 was the peak of the share of corporate equities that was held directly by pension funds, 27% of all corporate equity, and this includes the equity of non-listed corporations here. So also corporations that are not listed on the stock exchange are in this data. There's no way of separating them out. And then, since then, the share of corporate equity held by pension funds at that time, in the 80s, 90s, pension funds were the most powerful investors in the US and really worldwide. They drove the corporate governance agenda, corporate governance reforms, and the rise of the shareholder value model, which I would ideally like to talk a lot more about. But there's no time today, maybe in the discussion later, was really driven by the corporate governance activism of pension funds. Since then, their share has declined, and this is not because their size has declined, as you can see in the left-hand panel here. That has continued to really rise very fast, but because increasingly these pension funds have invested via the yellow part here, and also some other actors. So via mutual funds, and in recent years, especially via exchange traded funds, which has been a very fast growing segment. And so today we are in a situation where 22% of, the big three asset managers, BlackRock, State Street, and Vanguard, in 2018 already held 22% of the equity of the average firm in the S&P 500, which is just the main stock index in the US. So they held almost as much as all the pension funds together in 1985. And this is a very significant share, which gives these firms a lot of power in corporate governance. And to understand or to explain why I think we can talk about asset manager capitalism as a distinct corporate governance regime, I'm showing you this table, which shows 4 corporate governance regimes that represent, basically, you can read this from left to right as a timeline. And here in the first column, you have the 4 most important hallmarks of each corporate governance regime, and the names of these regimes that I would give them and that I mostly take from the literature are down here in the bottom row. This is all explained in greater detail in this chapter, which you can find online, open access. So we can't go through all of this in detail, but the main point of interest is that as compared to this post-war situation in which shareholders were just households, the concentration of share ownership has increased massively from very low to medium with these pension funds to very high. So the top 3 hold 22%, 25% of outstanding shares today, which means that whereas shareholders, individual shareholders used to be weak and only had the option to sell their shares in order to make their preferences heard, exit in the terminology of exit and voice. Pension funds were in a kind of sweet spot. They had both. They were big enough for their voice to be heard in corporate governance. They owned 0.5%, 1% of the stock of any given corporation, the big ones. So they could be heard, but they were small enough that they could also realistically sell their investments in any individual corporation. Whereas today we're in a very different world where potentially these largest asset managers are very strong, 10% of the vote in the case of BlackRock and Vanguard, gets them very close to actual control over, or at least they're often the swing vote in annual shareholder meetings, but they do not have a realistic exit option. They can't just go and sell their investment in, for example, when there was the Volkswagen scandal in Germany, BlackRock could not just have gone and sold its investments in Volkswagen for 2 reasons. One, these investments are simply too large. You cannot just dump 6% or 7% of the stock of one of the largest corporations in the world. That would crash the stock price, and you would take quite big losses on the later shares that you sell. You can't sell all of them at the same time. And second, because most of this money is invested via index funds. So they just replicate the German stock index, DAX, and Volkswagen accounts for a certain percentage of that index, and therefore BlackRock's Germany index funds are invested in that company with a certain share in order to replicate that. And so for both reasons, there is very little exit option. At the same time, we have so this configuration that the strongest shareholders are the biggest shareholders are quite powerful in corporate governance is not so different from a period that is best described as finance capitalism, going back to the writings of Rudolf Hilferding and others about the German and US corporate governance around 1900. Basically, the banks at the time were what the asset managers are today, exercising quite strong control in the corporate economy, mainly because they were lenders, but also because they were represented on corporate boards and so on and so forth. But what is really different from today is the extremely high degree of diversification of these asset managers. BlackRock doesn't just hold shares in a selection of companies, but in basically all large publicly listed companies, because their main business model is to invest via index funds, and so the investment is spread out over all companies in the index, and there are many indices, but there are also many index funds, and so BlackRock holds shares in literally tens of thousands of companies worldwide. All right, I would like to talk more about this, but I think we have to really move much faster now. What does this mean for corporate governance? I would say let's talk about this during the Q&A. There is a promise of what is called universal ownership, which is that in theory, diversified shareholders should internalize all negative externalities that arise from the conduct of individual corporations. Think carbon emissions. So, to the extent that a few companies' carbon emissions doom the planet, a shareholder that is invested in the entire planet should do something to reduce those emissions from those few companies in their portfolio in order to safeguard the value of the rest of their portfolio. So BlackRock is a giant social planetary planner, if you will. The problem is that in practice, there are all kinds of conflicts of interest, which I've listed here and which I don't have time right now to go through, but we can talk about them maybe later if you're interested. But for all kinds of reasons, somehow BlackRock has not yet emerged as a militant decarbonizing force. Okay, now just more briefly on the other part that I've written less about, but that we should talk about also here. So the footprint of asset manager capitalism in the private, in the non-publicly, in the sphere of private companies and also in the sphere of the non-corporate economy. And here, my two main examples are the financialization of health and care, which Christoph Schäublein has written very interesting things about the activities of private equity funds in the German care sector in particular. I've written a small article a couple of years ago with Philippa Siegel-Glöckner about about private equity and care in Germany also. And then there is this extremely interesting report by Daniela Gaborga and Sebastian Kohl from January about the financialization of housing in Europe, where they use a lot of data to document the rise of institutional investment in residential real estate. So these are just examples for a tendency that we can observe of rendering investable for institutional investors parts of the economy that were often in the past not even privatized, let alone financialized, right? So this is a big change, really, and of course there is lots of resistance, especially against, especially in Berlin at the moment against this. But what I just want to point out or to show you is again the importance of pension retirement capital for the power and influence of hedge funds and private equity funds, and this is especially private equity. Actually, this story here. Hedge funds play a bigger role in maybe the corporate economy and also in maybe commodities trade. Expect some hedge fund profits and losses in the near future from commodity speculation. So I've already shown you the growth of retirement assets, the importance for the growth of the mutual fund sector, but the same can be said, especially over the last 25 years, for the alternative asset managers. This is when pension funds everywhere, and again, first in the US, have moved into this sector. And there is kind of an optimistic view of this development and a pessimistic view. The optimistic view, which I highly recommend this book by David Weber, is that yes, pension funds have moved into private equity, thereby sort of investing in investment models that actively do damage to, you know, the workers that are the ultimate beneficiaries of these pension funds, for example, by privatizing public services and so on. But pension funds have learned about this problem and are trying to push their asset managers to not do certain things or to do other things. And actually, labor's capital can be a weapon in the hands of labor in the same way that organizing and the strike can be a weapon in the hands of labor. So that's the optimistic view. But then there is also a pessimistic view, which I have recently argued in this paper shown here at the bottom, which when I look at the history of pension fund investment in the US, and again, you have a timeline that you can read from left to right, you can observe, and I'm not the only one, of course, to say that there's a big literature cited in the paper. My point or my contribution is, what I would highlight is this latest push towards the most, let's say, aggressive and even predatory forms of investment via private equity. That is a big trend for pension funds. Pension funds, and the reason for this financialization is usually always the same. At some point, the returns pension funds are making fall short of what they think they need in order to fund their long-term liabilities to pensioners. So there's always a good reason to invest, you know, in progressively more higher risk investments. And today they do that by going into the highest risk ones. And I'll just put this here. Wait, no, we can come back to this. Just, I want to show you this. This is the latest data I found. Who is the investor base of hedge funds and private equity funds? The same analysis that I showed you earlier for mutual funds. And this is a little bit, this is for the US again, but that's basically where the entire hedge fund and private equity fund industry is located since 2013. You can't see very much, but if I try to single out these, let's say, nonprofits, sovereign wealth funds, and then public and private pension funds. So let's say non-capitalist, these are not capitalist enterprises like some of the other ones, right? And these are also not rich households that are just trying to, you know, get the highest return on the savings, but more or less like entities that serve a public function, if you will. And again, their share or they account for almost 50% of the asset base of hedge funds and private equity, which when I first saw this, I found it quite stunning. So this is just something, whenever you talk about, or there's talk about how to design a pension system, and of course funded pensions are always very contested. This is one aspect of social policy that I think is often underappreciated and under-discussed. This is a very, the role of pension funds as a driver of pension financialization is the take-home message here at the end of the talk. Look forward to your questions. Thank you.
Thank you very much.